Welcome to Yahoo Finance Live. I'm Shauna Smith along with Jared Blickery. Let's get you up to speed on the market action. We're looking at a mixed picture right now. The Nasdaq holding on to gains. We're looking at the Dow off just about 117 points. S&P just below the flat line. Traders digesting the latest comments that we got from Fed Chair Jay Powell earlier in the day. But Jared, we got to start with the movement that I know you're watching. That's in a number of the chip stocks on reports that maybe more export crackdowns are coming.
Yes, and we saw it was a sea of red on this screen earlier and some dark red too, so things have gotten a little bit better. You can see AMD and ASML climbing into the green. Micron also. We got earnings after the bell and we have an analyst we're going to be speaking to about that. But yes, those new restrictions on chips, and it's not just in the US. China's doing a very similar thing here. Let's take a look at what's happening in Chinese stock. For the most part, except for some of the auto ones, it is a sea of red. And that's because China is weighing its own options to restrict imports on certain U.S. chips into the region and also the U.S. exports as well. If these companies can't benefit from it, well, you're seeing their stocks decline right now. Let's take a look at the price action in the sectors. Only energy is up, well, it's up a little bit less than 1% right now, followed by retail as consumer discretionary, XLY, and then communications services. So interesting mix there at the top. To the downside, utilities, staples, those are the two biggest losers. Consider defensive sectors not too worrisome right there. And then a big look at our leaders in sentiment board, ARC. That is the best performing of them, although it's only up 1.5%. And we see Korean stocks taking on the chin here. Bitcoin a little bit under weather, but for the most part, I would say, Shauna, a mixed market today.
Certainly does look like a mixed market. 60 minutes, less than 60 minutes right now to go until that closing bell. But let's get a little bit more on the movement that we're seeing in chips. Nvidia among the names taking a hit on reports that the Biden administration is considering new restrictions on chip exports to China. We want to bring in Phil Orlando, chief equity strategist at Federated Hermes. Phil, it's good to see you here. From your perspective, this crackdown here that maybe could be coming, or further crackdown, I should say, on some of the exports from U.S. companies to China when it comes to chips, how big of a headwind, a challenge do you see this being for the industry at large?
Well, understand that what the Biden administration is trying to do, I think, is look forward and consider national security as an issue. Do you want your chief competitors like China, like Russia, et cetera, to have these very high-powered AI chips? Now, as we take that back and look at from a market perspective, Nvidia, just as an example, the stock's done phenomenally well as a result of this artificial intelligence FOMO that's been going on over the last 8 months or so. The stock has literally quadrupled from a little over $100 a share to about $440 a share over the last 8 months. From a valuation perspective, the stock's now selling at north of about 30 times revenues and about 130 times earnings. So you've got some frothy valuation levels. So if sentiment suddenly gets hit because there's concern about whether the Biden administration is going to put any restrictions on the ability of these companies to export their goods, then those valuation levels could come in. There's plenty of profits to take off the table. So might an air pocket be coming if that's the direction the Biden administration wants to go? Certainly, that's something you can't rule out.
Phil, sticking with chips here, how much of a headwind is all of this, all of these restrictions, is it for the Chinese government there? And also, when we think about AI, it's the next big thing, requires tons of resources and computing power. If the U.S. amps the arms race against China, at what point do they throw in the towel or do something a little bit more drastic than just tit-for-tat retaliations?
Well, you can't rule out the fact that you've got the two greatest economies of the world, and if China doesn't like the direction that we're taking this discussion, who's to say that they don't counter with something that's even more draconian? Now, speculation is that Treasury Secretary Yellen is heading over to China to meet with President Xi for a summit to try to smooth things over next month. So it's expected that the Biden administration won't put forth their formal plans until after Secretary Yellen's trip. They don't want to muddy the waters even more. But I mean, you can certainly see how the tea leaves are shaping up here. I think China has got to be prepared for some some draconian activity out of the Biden administration, and who's to say that they don't counter with something that's even worse? And what's the impact going to be on technology companies generally here in the United States that have done really well over the last 8 months with this huge rally in growth stocks?
Yeah, and Phil, going off that massive rally that we've seen in growth stocks, you mentioned the valuation of Nvidia, the massive run-up that we've seen in that stock since the start of the year. We've started to see some of the participation widen out just a bit. There was so much focus on that narrow market breadth up until about a couple of weeks ago. I mean, we're still talking about it, but when we talk about the next leg higher, the leadership, where do you see that coming from?
Well, you made a great point, Shauna. And as we look at the market, over the course of the last 8 months, even just so far this year, the S&P 500 as a whole has had a pretty good run. All right, you're up about 15% or so. But the big 8 technology names, Nvidia, Microsoft, Apple, those the obvious names, they're up more than 50%. If you strip those 8 names out of the rest of the S&P 500, the other 492 names are up like 2 or 3%. So what we would expect to see over, the next couple of quarters is, as you said, sort of a reversion to the mean. The technology stocks may give up some of those gains. They're frothy, to be sure. You've got a lot of value-oriented areas like energy, for example. Tech stocks in general are up 40% first part of the year. Energy stocks are down 10%. You've got a 50% spread in valuation. The energy stocks are selling at, 10 times earnings. They've got dividend yields that are, 3, 4, 5%, double or more versus the S&P 500. So we would expect to see sort of a reversion to the mean. The bad stocks doing better, the really good performing stocks sort of giving up some of those gains.
I want to ask you about the Fed, because we had Jerome Powell saying earlier this morning that 2 consecutive rate hikes are not off the table, and that's after pausing at the last meeting. So what happens if we get another rate hike, another 2 rate hikes? At what point does this require a repricing in the bond market of investor expectations? Because we've seen rate cuts now get pushed out to 2025 from by a number of analysts.
Well, I think that's exactly right. And the bond market, in our view, has had it right throughout. You look at some of the key inversion metrics that we look at in Federated Hermes, the relationship between the Fed funds rate and benchmark 10s, 2-year treasuries and 10-year treasuries, 3-month treasuries and 10-year treasuries. All of those metrics are significantly inverted and are telling us that we should be expecting a recession in the United States, not today or tomorrow, but perhaps a year from now. And then you've got some of the economic metrics. The leading economic indicators have been negative 14 months in a row. The ISM manufacturing index has been below the critical 50 contraction level 7 months in a row. All of these things have been excellent leading indicators to tell you that the economy is slowing and perhaps slowing in a recession when you go back and study the last 50, 75 years worth of data. So when the chairman of the Federal Reserve comes out and tells you we are fully recognize that nominal headline inflation has come down sharply over the last year, but core inflation, which is the metric that we're really paying attention to, has been very, very sticky. And it may take another 2 or 3 years before it gets to our target level. And therefore, you could fully expect that we're going to tighten policy a few more times in the second half of this year. You've got to recognize that when you look at something like a Phillips curve analysis, for example, when you're trying to bring inflation down, you're raising interest rates to do that. The rate of unemployment is likely to move up. The pace of economic growth is likely to slow. And I think that the equity market, to a significant degree, has been whistling past the graveyard the last 6 months. And I think there needs to be a reversion to the mean with stocks as well.
Well, Phil, what do you think the reaction will be in the equity market, more specifically, if we do see a recession? Because we've been talking about the threat of recession now for quite some time. And to your point, investors haven't seemed to care too much. They're not too worried about it.
Well, again, because it's far off. I mean, we're calling for a slowdown in the economy. Maybe it's recession, but it's not going to be tomorrow. It's probably going to be something next year. So equity markets right now are sort of thinking, well, maybe we dodged a bullet. Maybe, it's going to be a rocky landing or a soft landing, or maybe no landing at all. maybe the economy just reaccelerates and we dodge that bullet completely. We're a little more cautious at Federated Hermes. We're still considering the possibility that we go into recession perhaps 6 months from now or a year from now, and as a result, we're still keeping the defense on the field. We've got some growth, some technology, but we're underweight those areas. We're more overweight the more defensive, cheaper, higher, lower beta, higher dividend yielding areas, anticipating that, maybe we hit an air pocket over the next couple of quarters because the realization of an impending recession, maybe that risk becomes, clearer to investors later this year.
And Phil, all of this is happening not in a vacuum in the U.S., but we have a number of central banks all over the world doing different things. Some are raising interest rates, some are lowering, different strategies, different goals. And it's been a long time since we've seen all the central banks kind of acting in unison. What are the dynamics here? And do you see the central banks getting back to a place where finally everyone seems to be on board, marching in the same direction?
So I might take a slightly different tone there. That certainly Europe is tightening because of the inflation problem. Even though the United States, our central bank, paused at the June 14th meeting, I still think the bias is hawkish and higher here. As Powell said this morning, we may very well see 2 more, quarter point rate hikes in the second half of this year because of this divergence between headline and core inflation. The only central bank that has taken a different tack is China, the PBOC. And the reason for that is the economic growth that they've seen coming out of eliminating their self-imposed COVID lockdowns, late last year, beginning of this year. I think they expected to see much more robust economic growth, and that hasn't happened. They're starting to get nervous now. So I think you're going to see more aggressive fiscal and monetary policy coming out of China to try to boost their economic growth prospects and get GDP back to, maybe a 5% run rate by the end of this year, maybe something in the 6 to 8% neighborhood by the end of next year. I think the rest of the world, the Eurozone, the UK, Japan, the United States, we're still significantly concerned about how sticky, how persistent core inflation is. And as a result, that suggests tighter monetary policy out of those central banks, which is likely to slow economic growth and increase the rate of unemployment, as they're continuing this policy.
Phil, let's talk about how to play all this. You mentioned the fact that you're seeing some opportunity in some of the names that haven't exactly participated in the rally that we've seen in the first half of the year. Energy is one of the sectors that certainly has not participated in a lot of this enthusiasm. Is there a buying opportunity there?
Yeah, I really think so, both from a crude oil standpoint and from a market standpoint. We touched upon the market a moment ago. In the first half of the year, the technology stocks, growth stocks, have done phenomenally well. They're up 40%. Energy stocks are down 10%. So you've got a 50% valuation imbalance just in the last 6 months between how these groups have performed. And as I mentioned, from a valuation standpoint, you've got single-digit PEs in energy, and you've got dividend yields that are double the broad market. From a crude oil standpoint, you're in sort of a mid-60 to mid-80 kind of a trading range on WTI. We're only a couple of dollars off the bottom end of that range. And let's see how the fundamentals play out over, the next 6 to 12 months. OPEC has cut production by about 4.5 million barrels a day. We've still got to refill, 370 million or so barrels of oil into the Strategic Petroleum Reserve. We've just passed, we've gotten into the summer now, summer driving season, heat, air conditioning season. We've got an El Nino effect. What does that do to the risk of the hurricane season? Might there be any damage to refining capacity in the Gulf of Mexico? There's any number of things that could reduce the supply, increase the demand, force prices higher, over the course of the next 6 months or so, and prices are coming off a very low base. So given our contrarian nature here, I think energy doesn't look like a bad bet. It's cheap, and the risk in crude prices, in our view, appears to be higher.
Yeah, let me ask you about OPEC, because we had the Saudis unilaterally cut, I believe it was 1 million barrels per day, and that was to shore up the price of oil. That was about a month ago. And now we see Russia, there's an attempted coup, maybe call it what you will. Maybe the power structure there is in danger. Russians haven't really been playing that much ball. They haven't been cutting their production in line with the rest of OPEC Plus, which maybe it's only the Saudis anyway. Just wondering how those dynamics shape your view of the oil market.
Well, it's potentially significant because the three major energy producers in the world are Russia, Saudi Arabia, and the United States. OPEC Plus has cut their production by 4.66 million barrels a day, and they plan on keeping those cuts in place through the end of next year. The Saudis stepped forward and announced they're going to part of that 4.66 million barrels. They have 1 million barrels of it. The Russians have cut 500,000 barrels. But to your point, given the political instability that's going on in Russia right now, potential coup, whatever, does that represent some instability in the energy production industry within Russia? That's a very important industry for them. So if their problems result in them, at least temporarily, reducing their production, given incremental demand, summer driving season, heat, need for more air conditioning, disruption with production capacity due to hurricane season, anything of that nature, that could create a temporary imbalance, which would push the prices of energy higher, and theoretically the prices of energy stocks higher as well. So, I mean, the sort of wild cards that we're talking about, I mean, we don't have any knowledge of whether or not it's going to be a bad hurricane season, or whether or not we're going to have an extraordinarily hot summer, or whether or not Russia is going to have some sort of a political coup. But the risk of those things suggests that given the price of crude oil being as low as it is, we could see crude oil move higher, and that could certainly boost the prospects of energy stocks, at least in the near term.
Lots of moving parts there. I'd forgotten we have potentially a southern oscillation to deal with in the form of El Nino. We have to leave it there. Really appreciate all of your insights. Phil Orlando, Chief Equity Strategist at Federated Hermes. Thank you. And we're just getting started here on Yahoo Finance Live. Coming up, President Biden making the case for how his policies have benefited the U.S. economy. We talk the latest in Bidenomics later in the show. Plus, Micron earnings dropping after the bell today. We're going to dive into those numbers in the 4 p.m. hour. And shares of Tesla. Those are in focus today as investors look towards Q2 delivery numbers this weekend. We speak to Barclays senior auto analyst on the other side. Stick around. Shares of Netflix in the green today following a price target hike at Oppenheimer. The investment bank raised its outlook to the streaming giant up to $500 a share, and that's up from $450. Yahoo Finance's Ali Canal is here with more. Alexandra, give us the details, please.
Yeah, Jared, the bulls are out when it comes to Netflix. Now, Oppenheimer's Jason Helfstein now joins 3 other analysts for that $500 price target, which is the second highest price target on the street. Cowen's John Blackledge, Guggenheim's Michael Morris, and Wells Fargo Steve Keyhall with that $500 price target. But Pivotal Research currently has the highest outlook on Wall Street at $535 a share. So potentially even more room to run on this stock, which is already up more than 45% year to date. As you're seeing on your screen now, according to data from Bloomberg, Netflix has about 28 buy ratings, 24 holds, and just 4 sells. Now, Helfstein cited a few areas of growth for the company, like the bullish data surrounding the password sharing crackdown. He also called out the possibility of the company discontinuing its lowest price ad-free plan, that they're currently testing that in Canada. And if they do that, Helfstein argues that that would boost average revenue per subscriber and unlock about $4.4 billion in annual revenue. He also called out the ongoing writer strike and how that could serve as a near-term tailwind given Netflix's long programming lead time, deep library, and exposure to more international content, which is currently not impacted by the strike. It won't be. That's just based in the U.S. And then another thing to note is we're seeing industry-wide layoffs across the board in media. And he wrote to in his note to clients, quote, Netflix is largely benefiting from media job cuts as competitors struggle amid ad market weakness and subscription services cash drains. So a lot of tailwinds for this company, especially at a time where we're seeing a lot of users turn to streaming for their overall TV viewership as opposed to cable and some of those other competitors.
Ali, Netflix got me. I signed up $20 a month. Finally, after about 10 years, they got me. So
wow, and then you signed up for one of the highest
you went all out
tiers.
for
You went all
that.
in.
I try to go all in.
Okay, well, what are you watching? I just want to know real quick.
It wasn't for me, so I don't even know. I'm embarrassed to say. I don't have any favorite programs on Netflix. So.
Okay, well, I have a whole list that I'll give you.
Yeah. I'm looking for a new show, so we can all talk about this.
Okay.
All right, Ali. Great stuff. Thanks so much. Well, Tesla shares have been on a tear since the start of the year, surging more than 100% amid hype surrounding AI. But a closely watched Tesla bull, he recently downgraded the stock, saying that the recent rally ignores questions on near-term fundamentals. Joining us now is the analyst behind that call, Dan Levy, Barclays senior autos analyst. Dan, it's great to see you. So you raised some very, very good points in this note, starting with the headline there, the challenging near-term fundamentals. What are those challenges?
Yeah, thanks, Shauna and Jared for having me. Look, our view is Tesla is in the lead in the global race to an EV future. We think they have a significant cost lead. We think that there is even a midterm catalyst path as far as it relates to the launch of Model 2 and tremendous scale there. And we're even willing to acknowledge that there's a large non-automotive opportunity for Tesla. But I think what we've seen shift from the start of the year is a very different picture on demand in the EV world. And what that's led to is a very different outlook on margins for Tesla than we expected at this time last year. And so we thought that the current run-up in the stock did not reflect that, hence the move to the side.
Dan, I've seen a number of analyst reports, not only on Tesla, but also Alphabet, for that matter, talking about the incredible price return that's happened this year on the share price. And I guess it was unexpected. I guess where I'm going is you lowered your rating on Tesla, but you actually upped the price target. Something doesn't happen every day. Is that just kind of throwing your hands in the air saying, well, the price run up was great, but we have to kind of wait and see for what the next step is?
Yeah, I think that's a fair way to look at it. I think it goes back to, again, the idea of the multiple for Tesla has always been rich versus what people expected. And I think this relates to the question of how much growth should we look to in the future, and what are the non-automotive opportunities in Tesla? We're willing to acknowledge that there are significant opportunities ahead, and in a market that's willing to give more credit to that, we think that that needs to be reflected in the price target. But again, the rating also, we think, has to have some connection to the fundamentals, and with still a very large question on what the floor is on margins, what is elasticity of demand. We've seen, data points supporting elevated inventories, especially for Model 3. We felt that the rating needed to reflect that, hence the move to the side.
Dan, going off of what you were just saying, just in terms of the demand picture right now and where we are today, certainly different than maybe where you thought we would be going back a year ago. What does that then tell us just about some of those other leading manufacturers when it comes to the EV space and some of the traditional automakers like Ford, GM, which we know are really investing so much in the future of EV and certainly a priority there for those two companies?
Yeah, thanks. It's a really good point, because the way we've characterized it is that we've really seen a shift away from a period of EV euphoria, which really engulfed the sector the last couple of years, right? And so if you added up, for instance, all of the targets that the other Western automakers have provided on EVs, the spend targets, right? Automakers the last couple of years collectively committed to something like over $500 billion of spend on EV. And I think that part of that reflected some broader EV euphoria that was in the marketplace. But what we've seen is really a reset on some of those expectations, right? A few things have really changed in the last half year or so. One is that we've moved from a supply constrained market to a demand constrained market, right? So we used to think that demand was infinite. That's not the case anymore. Second, there used to be a wide open capital markets with open funding. That's changed. The capital markets have been shut. And then the last piece is that we've moved from a market that was willing to look past EV losses, that was willing to underwrite losses. That's no longer the case. And so as we look at some of the other automakers, for instance, we cover Ford and GM, while we think that they're still very committed to an EV future, we know this is the direction they're going. The spend and the product are all aligned with this. We think that the pace may be a bit slower than what they've communicated. Some of the volume targets are just not going to be met because they're going to proceed a bit more slowly and cautiously.
And you mentioned Ford and GM. They're on board with Tesla, at least when it comes to charging. How big of a deal is this that they are adopting Tesla's standard, which prior to this was only unique to Tesla? We talk about Tesla as more than just a car company. Does it really fit in with this paradigm that this is something that they're also an infrastructure company? They also have that as a mode as well.
Yeah, it's a good point, and we certainly appreciate that part of the rally has been these charging announcements. We think this is a positive validation point for Tesla. We think this is positive for the industry that you're moving to a unified charging standard, and we've seen others adopt this as well. But we think for Tesla, it's still relatively a small piece of what the revenue is, right? So by 2030, we think that the Ford and GM opportunity, just given a slower rollout on EVs and volume than what they've communicated, it adds up to roughly $1 billion of potential revenue for Tesla by 2030 on the charging front. That's a nice amount, but in the scheme of where Tesla revenue is, we're at almost $300 billion of revenue. That's a third of a percentage point. So really, somewhat immaterial, but it does help to validate the Tesla approach, which is positive.
All right, Dan Levy, we have to leave it there. We're going to downgrade on Tesla to equal weight, raising the price target, though, by 18% to $260 a share. Dan Levy, Barclays Senior Autos Analyst. Thanks.
Thank you.
Well, coming up, President Biden making his pitch on the economy to voters. Despite legislative victories, inflation still hanging over Americans' heads. White House Council of Economic Advisors Chairman Jared Bernstein joins us right after the break.
When I took office, the pandemic was raging and our economy was reeling. Supply chains are broken, millions of people unemployed, hundreds of thousands of small businesses on the verge of closing after so many had already closed. Literally hundreds of thousands on the verge of closing. Today, the U.S. has the highest economic growth rate, leading the world economies since the pandemic, the highest in the world.
That was President Biden making the case for how his policies have benefited the U.S. economy in what the White House now calls Bidenomics. You've heard that before. But with inflation still weighing on Americans' wallets, the White House is working to promote the broader economic message. Joining us now is Jared Bernstein, chair of the White House Council of Economic Advisors. Jared, thank you for being here today. President Biden planning for the future. I would argue that it's more important what Americans think about the economy, at least when they're voting a year from now, 15 months from now. What is President Biden doing now to ensure the success of the U.S. economy, especially over this next year to two?
Well, as you heard in his speech today in Chicago, he's framing out this idea of Bidenomics, which is building the economy from the middle out and the bottom up. And he's making a stark contrast between that and top-down or trickle-down economics, the failed idea that if you just cut taxes for rich people, that's going to somehow uplift the middle class, against decades of evidence that it just doesn't work that way. How does it work? Well, the three pillars of Bidenomics are reinvesting in America, reversing years of disinvestment in our public goods in a way that crowds in hundreds of billions of investment from the private sector, promoting more competition, both to lower costs and to give small businesses a fair shake, and empowering and educating our workforce. Put those together and you have a strong recipe for continuing some of the positive growth that we've seen thus far and continuing to make progress against inflation.
Chair Bernstein, it's great to see you here, Shauna. But what stuck out to me a couple of things stuck out to me in this speech. Well, one thing that did stick out to me was when the president said that he wasn't declaring victory yet. And I bring this up because from your perspective, as one of the top economic advisors to the president, what do you view as the or one of the biggest dangers to the economy? And how are you what's your plan just in terms of how you plan to work to address that?
Well, look, this is an economy, as I'm sure you've had in many discussions, that has some real headwinds. We obviously had some challenges in the banking sector, so important for credit flows. We have a hiking cycle. We have inflation that has come down significantly but needs to come down more. But also, some really important tailwinds. And I think too often people maybe don't get that balance quite right, especially those who look around and say we're in some kind of a recession. I don't think the data support that at all. And in fact, I think if you look at the recessionary indicators, they're all pretty clearly in a non-recessionary place. But if you look at a virtuous cycle between a tight labor market generating wage gains, generating consumer spending, which of course is almost 70% of nominal GDP, it becomes a little bit less of a mystery why we keep having this positive cycle, why we keep having job gain months that beat the forecast, I think 14 or 15 months in a row. So that kind of virtuous cycle is a real tailwind. There's also headwinds, and that's just the way it is right now. We have to, we have to be mindful of both of those forces.
And we heard from Fed Chair Jerome Powell earlier today, once again reiterating that 2 rate hikes could be necessary at this point in order to get inflation under control. You just mentioned the strong jobs market. If we do see 2 more rate hikes and consecutive at that, Powell saying that that's on the table, what do you think that is going to do to the labor market?
Well, I think without getting into any granular critique of Federal Reserve policy, which, I think one of the more important things we can continue to do to help inflation ease is make sure the Fed has the independence they need to do what they have to keep doing, what they have to do. I think it's important for us to recognize that Pillar 2, particularly today, Pillar 2 of Bidenomics is making sure we have an empowered and educated workforce. Now, what does that mean? when we talk about worker empowerment, one of the things we're talking about is the tightest job market in decades. Unemployment below 4% for a year and a half. Now that's the overall number, but we know that that means particularly low employment for groups that are far too often left behind. And that's something this president is acutely aware of. The importance of tight labor markets, he talked about it today under the rubric of full employment. The importance of tight labor markets to give workers a little bit more bargaining clout. That's also why he's one of the world's most pro-union presidents we've seen. Now, add that to educating our workforce so that we can complement things like our CHIPS program, where we're incentivizing significant investment in that sector, standing up a domestic semiconductor industry, and you're helping to build out the economy's supply side, in this case, labor supply, but also chips and infrastructure. Building out the economy supply side, its capacity, puts medium and long-term downward pressure on inflation.
Jared, while we have time here, I just wanted to bring up the fact you were recently promoted to the chair of the Council of Economic Advisors. What does the Council of Economic Advisors look like right now, and what kind of transition, if any, has it been undergoing?
Well, what it looks like is a staff of about 30 junior and senior economists who are some of the best economists in the country who come to CEA to help serve this president and his vision of Bidenomics. And we continue to do what we've been doing, which is provide the president and the senior staff with up-to-date analysis information on the data flow, much of the same kind of things you talk about here. Try to look around the corners and see where those headwinds and tailwinds I just talked about are taking us. Of course, every year we write the economic report of the president. And look, at the White House, we're very much involved. The CEA is very much involved in our policy processes as well, as we think through how to best implement our investments in clean energy and electric vehicles and semiconductors, making sure that the economy stays on track at the same time that we're building from the bottom up and the middle out, very much in the spirit of Bidenomics.
You mentioned the investment that the Biden administration has done with the CHIPS Act. Obviously, chips being a priority, bringing manufacturing to the U.S., a massive priority here for the Biden administration. There was also a report from the Journal this week just that we could see more crackdowns on exports to China of those chips. I'm curious from your perspective, the economic implications, if any, of these wider crackdowns. Do you see any from that?
Well, certainly one of the values of the legislation that we've been talking about, whether it's the CHIPS Act, the Inflation Reduction Act, or the bipartisan infrastructure law, is learning a critical lesson from the pandemic about the importance of resilient supply chains. Now, look, inputs, intermediate goods flowing here from abroad, that's still going to be part of our economic model, of course. I mean, if you just look at battery production, yes, we're very interested and full speed ahead in terms of developing EV and battery production here in the United States. But some of those materials are going to come from abroad because that's where they exist under the ground. So I think we're going to have to both be mindful of the importance of our trade flows while we really implement one of the insights of this president in this space, which is that for years, trade policy was built over the concept that workers, that Americans are solely consumers and not workers. That as long as we think about cheap goods, Americans as consumers, fine. But look, if trade policy is hollowing out a community, if it's shipping jobs overseas, if our system incentivizes manufacturers going abroad, that is not something that's okay with this president. That is antithetical to Bidenomics, to investing here. So yes, absolutely the case that Americans are consumers and they benefit from trade flows, but they're also workers. And that's one reason why 800,000 manufacturing jobs since this president took office, that's a very important benchmark for us.
One of the other things that President Biden did tout in his speech today was a high-speed internet expansion across the U.S., a massive investment here for the U.S. in terms of what that's going to look like over the next several years. This is an interesting topic because a number of Republicans have been touting this investment, even though they voted against it. How are you looking at this? And I guess, what do you think this is going to do just in terms of advancing the U.S. economy for years to come?
Yeah, I saw a tweet from the president today. One of the senators who voted against that measure was touting it, and the president said, you know, see you at the ribbon cutting. Look, I'm an economist. I'm going to keep my head down and work 24/7 on implementing the president's vision, which he ably described today as Bidenomics. A key part of that's really one of the first pillars is domestic investment. Now, this investment, sure, ports, bridges, roads, the environment, education, broadband, as you just talked about, you know, rural broadband, making sure you have affordable access wherever you are. I mean, that's economic oxygen these days, and we know that. But a key point is that these public investments crowd in private investments to the tune of almost $500 billion so far. And you can see that if you look at domestic manufacturing, construction of facilities, it's up. It's about doubled this year, while it was flatlining under our predecessor. So that kind of crowding in of private investment is a key to what we're about here. We're going to implement that. I'm going to let the politics do what they're going to do, you know, delivering on Bidenomics, that's what we're talking about today.
All right, we appreciate you keeping your head down and letting politics do as politics does. Thank you for that, Jared Bernstein, chair of the White House Council of Economic Advisors.
BlackRock, the world's largest asset manager, is betting big on the AI boom. Josh Schaefer is here with those details. Josh, what does that look like?
Yeah, Shauna, so I was over at BlackRock today for a media presentation on their second half of the year outlook. And one of the biggest takeaways was AI and really sort of what AI means when we think about the broader markets and what could happen over the next couple of years. So they called it a, quote, mega force. And other things that they call mega forces include aging populations and the low carbon transition. So that's how high up we're stacking AI, right? Saying it means that much. And something that was interesting that came up was Tony Desperito, one of the BlackRock CIOs, said that basically the difference between AI and some other bubbles we've talked about, or if we're calling AI a bubble, we've talked about the metaverse a lot, right? And he said the difference here, when you think about this 2 years later, is the demand is real. When you think about a company like Nvidia and you think about all the GPUs that are being ordered and the fact that there are actually orders coming in, you can see how this contributes to earnings quicker, which I found pretty interesting. And then I do have to give a shout out to our friend Sam Rowe over at Ticker. He asked a great question about the valuations, right? We've seen these stocks go way up. When we think about Nvidia up over 100% this year, even you could throw in some of the other ones like a C3 AI or something up hundreds of percents, right? It was interesting to hear what BlackRock said back to that question, essentially saying, well, yes, the valuations are getting very, very high, so you want to be nimble, but we're not saying necessarily buy into AI right now as much as stay invested. Stay along for the ride. If you got in on this ride and you've been on the ride for 2023, they recommend staying in it, which I found interesting.
Yeah, that's such a critical point because I think when we talk about all this hype surrounding AI, a lot of people have brought up the hype that we saw around the metaverse and even bringing it back to blockchain and crypto and what exactly played out there and wondering whether or not AI is going to go the same way of it, but it sounds like, at least from BlackRock's perspective, that is totally different, and it's very important to make that type of distinction.
Right, and the other thing too is they were talking a lot about AI isn't just tech companies, right? We're not just talking about semiconductors and talking about search. AI can also help you with jobs, and it can help you sort of basically be more efficient when it comes to spending. So when you're thinking about AI investing and you're thinking about these companies, it becomes important to think about who is an AI spender. How much is that going to increase their cost? Because if everyone has to incorporate AI, there are going to be certain companies that just have to pay for AI. It just becomes an added cost, right? And it doesn't necessarily help their profits, versus there are going to be companies that are selling AI and using AI to bring down their profits. And that is where, of course, you want to be investing, is companies that are increasing their profits.
Yeah, and that's why so many companies are mentioning AI and their investment there to what they hope to be further help their productivity. But we'll see. All right, Josh Schaefer, thanks. Coming up, we have the latest on the legal battle over the Microsoft Activision Blizzard deal as the CEOs of both companies testify. We'll be right back.
The battle between the FTC and Microsoft rolls on, but today it's another game taking center stage at the federal court. Yahoo Finance's Dan Howley is here with more. Dan, please spill the details.
That's right, Jared. We're looking at these the last day of the hearing between the FTC and Microsoft over the Activision acquisition. Basically, what the FTC here is asking for a temporary restraining order that would allow them to stop Microsoft from acquiring Activision Blizzard or closing the acquisition prior to the FTC finishing up its own case, looking at whether or not it should allow the deal to go forward in its entirety. So this is kind of a hearing before the real deal, but the consequences of this could mean Microsoft abandoning the deal if it can't move forward, because if it doesn't close the deal by July 18th, it will have to give Activision Blizzard a $3 billion reward for the acquisition not closing on time, or renegotiate the terms of the deal. So they may do that or just abandon it entirely and just give up that $3 billion. If they win in this, it could mean the FTC eventually giving up on the case, just because it would be a blow against them. So this really could have big implications as to the future of this acquisition. So far, we've heard a ton of interesting news ranging from Sony originally saying that they weren't worried about Microsoft acquiring Activision Blizzard, saying that they didn't think that they would make Call of Duty an exclusive to the Xbox. Xbox head Phil Spencer saying that they would continue to provide Call of Duty on PlayStation, and that if they degraded that product to favor the Xbox version, they would basically be shooting themselves in the foot, because consumers would then just have a field day and go against Xbox. So a lot of interesting information back and forth here. So I think, when it comes to this hearing, we hope to hear something soon in perhaps today, likely not, but in the coming days. And then we can finally maybe get some resolution as to whether or not this deal does go forward or not.
Dan, that's a great report. I just have to address the elephant or the cat's paw in the room. If you look to your left, there you go. There was a cat's paw just making its way on screen. I swear.
Anyway. He darted away.
Yes.
He's a little punk.
All right. Thank you for that, Dan Howley.
Well, chipmaker Nvidia falling today on a Wall Street Journal report that the U.S. is considering new restrictions on AI chip exports to China. We're looking at losses of just shy of 2%. Well, Nvidia stock has certainly been riding the AI wave since the start of the year, hitting $1 trillion in market value last month. So what does the U.S. crackdown on China mean for tech and tech innovators? Joining us now for this week's ETF report, brought to you by Invesco QQQ, we want to bring in John Porter. He's a Chief Investment Officer and Head of Equity for Newton Investment Management, a BNY Mellon investment firm. He's also Portfolio Manager for BNY Mellon's Innovators ETF. John, it's good to see you here. So lots of focus on the news today for Nvidia and what exactly this means for tech innovation in the U.S. Since you're a portfolio manager of your tech innovators, or of your innovators ETF, how are you looking at this from a portfolio management perspective?
Absolutely. And if there's any animals in the background, please let me know, because there shouldn't be any. I think this is every day there's headlines that you need to consume. And this is certainly news that we have to analyze. And there's obviously a lot of political cross currents between the United States and China. And China is an important market for Nvidia. We can't ignore that. It's somewhere approaching 20% of their revenues. But I think right now, the news that there may be additional crackdowns on China is largely a non-event for the NVIDIA P&L right now. Demand for NVIDIA chips is so strong right now. There's such a backlog of companies that are desperate to get their chips, which are the key building block to build out AI capabilities. I really don't think this news is material for NVIDIA.
And let me ask you then, just maybe looking a little bit further into the future and just acknowledging the fact that this AI bubble is in a nascent stage and we tend to see these things come in waves. I'm reminded by the Bitcoin and the blockchain revolution, particularly late 2017, early 2018, when Bitcoin finally rose to 20,000. there was all kinds of excitement about that too. And Nvidia was actually building up their chip inventory. They got caught with a glut. I know we're not at that phase yet, but do you see us approaching a phase where we're really, the chip market could be a pawn in the AI bubble?
Jared, that's always a question that investors have to ask themselves, particularly with regards to tech. There's always a hype cycle that can get well ahead of the business realities, and I like to compare and contrast this like you did to Bitcoin, cryptocurrency, the metaverse, and other things. I think the difference here is the use case is clear. I think in the early days, and maybe even still currently for cryptocurrency and to some extent the metaverse, the use case is still trying to be explained. The use case for AI is very clear. You're not having to convince governments or corporate America how AI can help improve the productivity of their businesses, of their endeavors. So I think that's one of the major differences here.
John, how are you looking at valuations overall? Because it's not just Nvidia. Alphabet, I believe, is also one of your top holdings. Has had a big run up since the start of the year. Any concerns in terms of the valuations and what exactly that could look like for some of those top holdings that you have?
Absolutely. You always have to be mindful of valuation. And you talk about the hype cycle, you need to weigh sort of where the equities are priced relative to what the business potential is. Nvidia is an interesting one to look at. It's trading at somewhere around 45 to 50 times consensus earnings, which is well above average for the market. But considering their growth rates, considering how they're a critical building block for AI, which I think is one of the most seismic changes to the economic landscape that we've seen in decades, I don't think it's prohibitively expensive. It's fully priced, don't get me wrong. But I think given the growth rates, given how indispensable Nvidia is to AI, given their competitive leadership position over all the other chip makers, I think that you can make a case that the Nvidia valuation makes sense. And for many of the other mega cap stocks, they've had a very nice run year to date. If you step back, the vast majority of them are trading somewhere between 20 to 30 times earnings. And considering the amount of money they're pouring into future growth endeavors and the growth potential that they have, I think that they're reasonably valued.
And leaving the AI discussion to the side for a minute, if that's possible, I'll give you the floor. What other factors are you considering, challenges, tailwinds, whatever, within the current market environment?
Well, I'm a stock picker, but you can't ignore the macro landscape. I think that the surprise this year, positive surprise this year, has been the strength of the economy, and that's something that has been a very pleasant surprise for many investors. But you still have to be a little cautious about what lies ahead. Investing is about discounting the future, and there's still, I believe, a lot of risk to the economy from the cumulative effects of the rate hikes that we've seen, yet to be fully felt, but I think could rear its ugly head over the coming months. So that's something to monitor. On the positive side, I would just speak to innovation broadly. One of the things that we're seeing is the powerful impacts of innovation in every corner of the economy is unlocking growth potential in individual companies that we think is underappreciated in the market. And that's what this portfolio, the BNY Mellon Innovators Fund, is trying to take advantage of.
All right, John Porter, thanks so much for your time. No animals this time in your background. We got to wait till next time. All right, thanks so much for joining us. We'll talk to you again soon. Well, coming up next, we've got the closing bell on Wall Street. You're still looking at a mixed picture. Dow and S&P just below the flat line. Nasdaq barely holding on to gains. We'll be right back. That's the closing bell on Wall Street. The Nasdaq just eking out gains, getting a little boost here in the final minute or so of trading, closing up just about 0.2%. S&P and Nasdaq, though, closing just below the flat line, off the lows of the day, with the Dow off just about 72 points. Let's take a look at some of the top movers, and one of those top movers is Pinterest. The stock jumping on an upgrade from Wells Fargo to overweight from equal weight. The analysts there citing Pinterest's ad partnership with Amazon. We're looking at a gain of just about 6.5%. Wells Fargo saying that the Amazon deal is going to be a strong catalyst here for the company. They expect it to launch in the fourth quarter, just in time for the holiday season.
Well, how about that? I want to go to the Wi-Fi Interactive because I'm going to chart some of the social media I guess our heat map here. What you notice is these are year-to-date returns. So Microsoft, Google, Meta, those are the three big ones. Everybody else is just tiny. You got to kind of squint to see Pinterest down here, but that is quite the interesting chart. Very volatile for this smaller member. They really haven't scaled up their monetization yet, and they're also, I would say, not in the same camp as some of the Meta offerings. They don't have to suffer some of the blowback that they do from social media, and they're not developing the metaverse. So having said that, I'm going to switch gears here. You got to talk about General Mills shares sliding on a revenue miss. Retailers are reducing inventory, but there are some good news for investors. The board did approve a dividend increase, and just thinking about the stock price and also in relation to their margins, that's been a huge one. They've effected a number of price hikes over the last year in response to rising inflation. They do think most of those have finally abated, or they might be a few more, but they think most of that is in the rearview mirror. The labor shortage, that's probably in the rearview mirror. So it just kind of shows you that the economy is slowly recovering from some of the displacements of the past.
Yeah, and I think this also just really points to the spending trends or lack thereof that we're seeing from consumers and how consumers are prioritizing what they are spending on and how much they are spending. Because you take it into account what we heard from General Mills, a slowdown in the year ahead, a cautious consumer. They're all about food choices here. Price hikes no longer making up for the slowdown that they're seeing in sales. Certainly worrisome signs here for the company, at least in the short term. Their volumes were down in all categories except their North America food service. So seeing some pressure on the stock today. Again, the slowdown here, the question is how long consumers will continue to pull back on some of their spending habits. All right, let's also take a look at one of the top trenders on Yahoo Finance, the top trender today, and that's Joby Aviation. Shares popping 40%. The maker of electric air taxis getting another step closer to commercial flights as it gets regulator approval to test flights here. We certainly are seeing the excitement, the reaction in shares today. A massive move to the upside, Jared.
Yeah, I got to tell you, though, something about an electric aircraft. I don't care if it's a helicopter or if it's fixed wing. That just kind of gives me the heebie-jeebies.
You're normally a pretty good risk taker. I'm the one that's on the sideline for this.
I don't know why I don't trust it. I know I should. It's the batteries? No. I think I take that back. It's not the batteries. All right, we got to move on to the chip space. Nvidia and AMD are today's two casualties when it comes to the U.S.-China trade war on chips. Both stocks, they took a tumble today as it was reported that the federal government is considering upping the restrictions on exports of computing chips that are an integral part to building AI systems. But this could come at a greater cost when we look at the geopolitics of the situation, with some strategists warning that this could have huge implications on China's economy and military. Yahoo Finance's Ines Ferre has been following this today. But before we chat, got to take a look at what President Biden has to say on the issue today.
Public investment declined here at home. Industries that we invented started to move overseas, like semiconductors. I want to remind you, America invented these chips. But over time, we went from producing 40% of those world chips down to 10%. Not anymore. Biden economics means industries of the future are going to grow right here at home.
All right, we want to talk about this with Yahoo Finance's Ines Ferre. Ines, you were just listening to President Biden's words.
Yeah, that's right. And you can definitely tell that this is an escalation of what we've seen so far. The U.S. doesn't want China to have the most advanced technologies when it comes to AI chips. And this is, of course, on top of the restrictions that have already been put forth regarding tools for chip making, the most advanced, also regarding some of the technologies from Nvidia as well. Look, I spoke to one analyst, one strategist over over at Baird, Ted Mortensen, who basically said that this is turning out to look like into almost a geopolitical economic warfare issue. Why? Well, first of all, the U.S. is concerned that China may be leapfrogging the U.S. when it comes to AI technology. And these types of chips, these very, very advanced types of chips, are used for example, areas like economic growth being one big one, and the other one being military. So when you're doing this, when you are restricting the exportation of these chips, you are basically trying to restrict economic growth in one country, and you're also trying to restrict their military advancements. And so this is definitely, according to this strategist, I mean, this is going to be sort of a red line when it comes to China in trying to restrict this. As far as what impact that this is having on Nvidia and AMD, okay, down 2%, but look, Nvidia is up 182% year to date. AMD's up 70% year to date. So it's not having too much of an impact on the stock, but definitely an escalation from what we've seen so far.
Yeah, and I guess the question is, how much will China retaliate, and then what kind of effect might that have on the U.S. economy? Yeah, well, definitely this strategist is saying that China will not take this lying down, that they will retaliate. Look at what happened with Micron and that cybersecurity review that China did when it comes to Micron. You can expect that other big businesses that do business with China will be hit at some point. They may target some big business, and this is the way that they're going to do it, is through U.S. companies that do business with China. All right, thank you for that, Ines Ferre. And we have Shauna standing by with some breaking news, Micron earnings. Yeah,
Jared, I'm digging into these results right now. Looks better than expected, at least for the most recent quarter, and narrower than expected adjusted loss of $1.43. The street was looking for a loss of $1.59. Revenue coming in at $3.75 billion. That was better than what the street was looking for. You're looking at gains of just about 4% here in extended trading. In terms of what the company is seeing going forward for the fourth quarter, they see fourth quarter adjusted revenue of $3.7 billion and $4.1 billion. Estimate was for $3.87 billion. So the higher end there of the outlook that the street was looking for in terms of what they're forecasting, slightly wider than expected loss, though, for the fourth quarter. But I think a lot of the emphasis on this after hours reaction is on the beats here on both the top and bottom line, better than what the street was bracing for, a stronger forecast in revenue, a sign that maybe the glut that we have seen within the chip industry right now could be easing just a bit. So move here to the upside, Jared.
Yes, Micron particularly levered to the memory chip market, and I'm looking at the Wi-Fi Interactive shares now up about 4%. I'm looking at a year-to-date chart. By the way, here is our extended hours quote right there. Year-to-date, though, up about 34%. That compares to Nvidia, up almost 200%, but definitely not the high flyer some of these real AI stocks have been.
Yeah, certainly. And also Micron talking about the recent decision by China as, quote, a significant headwind. And just to remind everyone out there, China recently banning Micron chips and the key infrastructure over some national security risks. So Micron making some comments about that, the fact that that is a headwind here for the company going forward. And of course, I'm sure that will be a question or two on the earnings call this afternoon. All right, well, coming up, more earnings on tap tomorrow. Nike set to report its results after the bell on Thursday. We'll have a preview of what to expect when we come back.
Nike set to report fourth quarter earnings tomorrow, wrapping up its financial year on what is expected to be a high. Despite concerns of consumer spending slowing down, the brand outperformed estimates in February with 14% sales growth. Our next guest expects a similar outcome tomorrow and says the stock is undervalued. David Schwartz is a senior equity analyst at Morningstar. David, thank you for joining us here. So, broadly speaking, what are you expecting?
I think we're looking for relatively moderate growth of about 3%. I'm at 2.9% sales growth for the quarter. My APS estimate is 69 cents. In recent weeks, we've seen some analysts reduce their estimates a little bit. I have not done so. I think that Nike can make that number. Nike has a history of meeting or exceeding analyst expectations. Although there are some headwinds, certainly. We are looking at a slowing consumer right now, slowing spending on apparel in both the United States and Europe as well. But that is also counterbalanced by the increase in sales in China that are likely due to the lifting of the COVID restrictions at the beginning of the year.
David, when it comes to the sales out of China, do you think it's going to be strong enough to offset some of the headwinds that you just mentioned that's happening right now in North America?
Yeah, I do. The expectations are not very high. 3% sales growth for Nike is pretty moderate by historical standards, and that's with the benefit of China. So I don't think expectations are really that sky high for the quarter, and I think in recent weeks people have become even more pessimistic. So I think actually the upside potential is there because Nike does have a history of outperforming.
One more question on China. We've seen this escalation of, I'm not going to call it a trade war, but maybe tit for tat in terms of U.S. export restrictions on chips. And this kind of harkens back to the trade war, the actual trade war, the seeming nature of it we had with the previous administration, where China would in fact kind of retaliate on an item by item basis with every new announcement with the U.S. What is the danger that we re-enter that kind of environment and China decides wholesale that it's going to start blocking U.S. companies like Nike, or not hurting them, but I guess not enabling them to do business as they were in the past?
It definitely is a risk. Nike has lost some market share to native Chinese brands in the last few years, especially Anta and Li Ning. However, their products are still priced well below those of Nike in general, and Nike still is the #1 leader in market share. Nike has lost share because of trade restrictions, but also the controversy over forced labor in Western China that has affected Nike and as well as some other international brands. But Nike has really bounced back, I think, from that pretty well. Nike has something like 8,000 stores in China. Most of them are franchised. And I don't see the Chinese government or anybody else really preventing Nike from continuing to be the #1 sportswear brand in that market. Nike still has a very strong grip on worldwide sports, and that's not going to change.
David, there's lots of questions just about the extent of the pressure that we could see on Nike's wholesale business. We know that has been an aggressive focal point here for Nike recently. And then inventory levels. You mentioned the fact that some analysts have lowered their estimates going into these results. A lot of the talk has been on inventory levels, and maybe Nike doesn't have as great of a grip on inventory as they seem to have after the most recent quarter. What do you think?
Nike's inventories last year were definitely out of control. In the second half of calendar 2022, there was a big increase. Nike at one time was basically getting shipments for about 3 seasons at the same time. So that there were some problems, and those have not been completely resolved. I do think that the situation is getting better, and that's what we're hearing from retailers. We've had mixed reports from some retailers that do a lot of business with Nike, like Dick's Sporting Goods and Foot Locker. Dick's, I think, is doing pretty well. Foot Locker had a pretty negative report. And for the most part, I think that the market is not in great shape, but it's in better shape than it was 6 or 9 months ago. I think Nike is in the same situation where it is in better shape, but its inventories are not really where they should be.
Are there any lingering concerns over supply chain constraints, labor shortages, any of the things that we're hearing about in 2021, 2022? Are those carrying over? Is Nike still feeling the effects of that, or has it largely moved on?
Those impacts, I think, are largely in the rearview mirror. There has been some slowing in consumer spending in the last few months, I think, which probably has impacted Nike, but I don't think that the shipping problems really are an issue anymore. Certainly, input costs are lower, cotton prices are lower, oil prices are lower, and that's a benefit for Nike and other apparel firms.
What are some of the deals, especially with sports endorsements, that Nike's really hanging its hat on, kind of been a hallmark of their advertising campaigns in the past? How is this fitting into their current business model?
Nike still dominates in endorsements. They still have many of the top athletes. Obviously, Nike has a big relationship with LeBron James and, of course, Michael Jordan, as well as a lot of top athletes in international football and track and field. Nike will still get most of the top athletes that are out there because Nike is the biggest. They can always outbid others when a great athlete comes out. And their endorsement deals are in play. Nike usually does get those, and I don't see that changing at all.
All right, well, we will get Nike results after the bell tomorrow. We'll have it for you live here on Yahoo Finance. David Swartz from Morningstar, thanks.
Thank you.
Well, coming up, we are going around the horn and checking in on some of the top trending stories of the day. Ali Canal, Josh Schaefer, they're going to lead us with it. What are we talking about, guys?
One story that we're covering is what you may or may not be drinking during the 4th of July holiday.
And if you're lucky or if you're smart, it might be free. We'll tell you how next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by the one and only Shauna Smith, Josh Schaefer. We're talking a lot of top stories today, but I want to kick us off with Warner Brothers Discovery. Now, this is a stock I've been following closely. It's been dealing with a lot of challenges lately, especially after the CNN disaster with Chris Licht. You also had the flash bombing at the box office, a lot of media layoffs at this company in particular. But analysts that I've spoken with are very bullish on the stock moving forward. They think they've done a good job at cost cutting, and they say ultimately this is going to come down to the rollout of the new Max offering, which will reportedly include some live CNN content, which I think is a better strategy than what they had before with CNN Plus. So it's something that I think moving forward could have the potential. It just seems like there's a lot of turmoil surrounding this company right now.
Yeah, I wonder how big of a push or how big of a difference offering some of the live news content on Max, what that's really going to do here for subscriber numbers. Because, I mean, it's definitely a different approach than what we've seen from some of the competitors out there. When you take a look at Walt Disney, they have kept the news division separate than what they offer on streamers. Similar also to what we've seen in Paramount and Comcast. So I wonder if that's really going to move the needle here. It certainly is. I guess there's no harm in doing it as long as they're able to do it with the pay TV providers here, as long as that doesn't breach any sort of contract. But I don't know if it's going to.
The paid TV subscribers thing is a big part of it, right, in those contracts, because that's why some of these companies haven't done that, right?
Yeah.
Because you don't really have some of your best content to put out there. You remember even with the Olympics, NBC had a problem with that, with some of their Olympics coverage going back a couple years with what they were trying to do with Peacock. So if you don't have your prime CNN content, then is it really going to drive subscribers? I don't know, but maybe it does keep subscribers. I think having live content in general is very strong for a streamer because you get news access for when things are happening. I don't know, we work in news, so maybe I'm more biased to wanting to watch it. But
no, because I spoke with Bank of America analyst Jessica Reeve-Ehrlich, and she did say that live news increases engagement on the platform, and she does think live sports are going to be a big thing for Warner Brothers Discovery moving forward as well.
Yeah, I wonder, Allie, just to get your thoughts on that, just in terms of the contracts that they have with the pay TV providers.
Yeah.
Are they able to, I guess, how big of a hurdle is that for the industry when they are trying to incorporate some more of their live content on their streamers?
It is going to be a hurdle, and that was one of the main issues we saw with CNN Plus and why they sort of pivoted and did some of these different types of shows, because they couldn't really have their bread and butter content on streaming. So you wonder if they'll renegotiate, or if instead of the traditional programming that we know from CNN, maybe they're going to take some other type of live component and put that on Max as well. So that remains to be seen.
Yeah, and I also just think there's a lot of questions just what it's even like inside those walls there, right? CNN right now, Warner Brothers Discovery more broadly, given all the changes that the company has gone through, over the last 14, 15 months?
Yeah, but people love David Zaslav. They say he makes a mistake, he admits it, and he corrects it pretty quickly. That's his management style. He's very cutthroat, and I think a lot of investors and a lot of analysts are bullish on that.
Yeah, certainly. We will see if it pays off over the last year. Look at a loss, it's just over 8%. All right, guys, let's talk about another big name that I think we've all talked about in the past, and that's Allbirds. Lots of questions about what this company is going to do to move forward, to really change its strategy, get more people on board in terms of what they're thinking. They just came out with a brand new shoe design. I think we have a picture of it right now. I am not on board with this. So what this is, it's the first ever carbon neutral shoe. I believe it's called Moonshot here. They use regenerative wool. Whether or not this is really going to stage a comeback here for the company.
It looks like a sock.
I'm not sold.
It looks like a sock.
It's
Let's
like
just be honest.
Maybe that's cool. I'm not cool. I don't know what's cool.
It looks like a sock. I'm not cool either. But neither of those.
I'm cool, and I don't know.
Oh, you wear Hokas, so do I. I don't know.
Does that mean we're not cool?
Hoka, a company that's innovated well, right? When they needed to make more than one product.
I like
Isn't
to think
that
I'm
the
cool.
thing with Allbirds? Like, they made the one shoe, that tech bro style shoe that everyone was wearing with their button down in like 2018, 2019, pre-pandemic, right? They sort of got that early athleisure shoe brand in. And now they haven't made another shoe since. I think it's the Tree Runner, right? It's that common one. It's got the gum bottom, the mesh shoe.
I have.
Yeah, no, a lot of people have those. They haven't sold another popular shoe. That's literally just been it. And when they've gone to innovate, they've made things like this sock. I mean, I'm sorry, no one's wearing that.
Well, and to your point, yes, they came out with the athleisure shoe, but I think a lot of shoe manufacturers have a similar type of shoe, right? The comfy, lightweight, simple shoe. Hey Dudes is one that comes to mind. I can throw that in the wash, same as my Allbirds, which to me is important in a shoe, and know some of my friends it's important in a shoe. So I just feel like it's a trend that has sort of faded. Others have at least have gotten on board, which takes away a little bit of that exclusivity for Allbirds. And yeah, they just haven't been able to come out with something else that makes it different.
It gets to understanding who you are as a business, right? And so like investors can maybe start to understand that too with like who you provide shoes for. Because they had these cool shoes that I don't know if they were meant for people to wear to the office, but people were wearing them in the office, right? Or wearing them a little bit more dressed up than like running shoes. And now you have these that are just not the same target market at all. So like, what's the point? Like, who are you serving as a footwear company.
Yeah.
With your stock at $1.20.
Oh gosh, so bad.
Yeah, I was gonna say identifying who the audience is, obviously, that's very, very important here for companies that want to be successful, but also just better advertising what you even wear a style like that with. That is what I am trying to figure out right now in terms of if I
bro,
were to
not
get it.
finance bro.
Right.
Yeah.
You know?
Is it Brooklyn, bro?
I don't know.
So you're saying those are like a Birkenstock Boston kind of look?
Yeah, I can
and
see
like
someone in a
that's
beanie
okay.
and like wide rimmed glasses
Yeah.
wearing that in downtown Brooklyn.
I'd say it could be good for kids though, as a mom who
yeah,
struggles
that'd
to
be
get their
cute.
shoes on their kids all the time, ties
That would be
coming
cute,
undone.
actually.
It's easy, just
I
flip it
think
over
those
their
would be
feet
harder.
and
I think those would be harder to put on than you think.
stretch it out a few times.
I
It
trust
might be
the
a little
mom.
bit easier after
Yeah.
time. You gotta, never know.
All right.
Maybe that could be next.
A story I'm watching, a different story, but a fun one we've been following is these Bud Light sales, and it's been interesting to see what's happening with it. But more importantly, as we head to the 4th of July, you might be able to get free Bud Light, more or less. So they're running a promotion that if you buy a $15 rack of Bud Light, you can see right there, you get a $15 rebate back. Now you have to go online to file the rebate. So of course, don't forget to do that.
That's
which
the
a lot
worst.
of
That's
people
the worst.
probably
When you have
won't
to
do.
go online to file that, it just doesn't happen. At least
But
for me.
interesting, as we've been tracking, of course, Bud Light sales down about 30% over the past week compared to last year. They've been in that 25 to 30% range for a while now. Trying to reinvigorate maybe sales growth with this deal. I don't know. Are you guys buying it?
I don't think it's going to harm the company at all. Obviously, I think they're also banking on a lot of people, like Ali, what you were just alluding to there, not submitting their rebates, so they're going to get the full what they charge here for their Bud Lights, especially right now, because it is so critical for the company because sales have dropped so significantly. But they need to do something to turn things around, right? So this new marketing campaign that they are launching for the next several weeks, I think is a smart move. I think a lot of people that maybe boycotted Bud Light for just because it was a trending thing, it was a trending topic, I think some of those people are going to come back to Bud Light, but that's only part of the problem, right? Because then you also have the fact that beer sales across the board are slowing down, and Evercore was out with an interesting note on that, just saying that it is tough right now when you stack that up to some of those ready-to-drink alternatives out there that are very popular, especially with the younger generation.
It was interesting to look there. So when you expand beyond Bud Light and you think about AB InBev, right, and their overall seltzer sales, decline year over year from 2020 to 2021 to 2022 to this year. And right there you can see it compared to High Noon, which I would argue is one of the more popular ready-to-drink cocktails
Well,
right now.
that leads the category for sure.
And so like you could see High Noon sort of ticking up there, Ali. I don't know. That was something that stuck out to me when you think about beyond beer, what AB InBev can do to maybe help itself out here.
And in this note, one thing that did stick out to me as well is the fact that hard seltzer just continuing that fizzle and is truly having a problem, no pun intended. I mean, that's down 15 basis points sequentially, 555 basis points year over year. It's the worst in the seltzer category, worse than Bud Light seltzer, which I think you know is bad because I'm going out, I'm never reaching for a Bud Light seltzer. I would get
Bud
truly
Light
over
seltzer
that.
is easily the worst
But
seltzer.
I wonder why. I mean,
Easily
you guys,
the worst tasting seltzer.
you guys are younger than me. You're a lot cooler than me. Why hasn't, do you think, seltzer caught on? And why was it just a fad? Because there was so much excitement about it.
When's the
I
last
think
time
it's
you had
easy.
one?
I mean, like not that long
The
ago,
malt,
to
the
be
malt
honest. I
liquor
don't do
flavor
much.
in some of these seltzers are
Yes,
just not good.
I think that's what it was.
think
And then you had High Noon come in, and it
Right.
wasn't this malt liquor. It was the same calorie benefits, right? It was a healthy alternative. And I think, at least for my friends, they gravitated towards High Noon over the White Claw, even though White Claw is still doing not too bad. I think they're only down 80 basis points year over year, but they're up sequentially. So still, though, a decline in the segment overall.
People wanted something that wasn't beer, right? I think that was obvious. But then when you get into the next level of it, people like the flavor of something that's a vodka soda and maybe not as over fruit forward. I think some of the ready to drink, like a White Claw or Truly, are very fruit forward if you have some of those and like a little sugary.
Yeah.
But what are you guys drinking 4th of July? Quick, what do we got?
I don't know,
Out of
maybe a
this
glass of
category, I would
wine.
pick a
I would
High
honestly
Noon.
take
I would
any
pick
sort
a
of
High
drink
Noon.
right now, so I'm not going to discriminate.
I'm going with that Bud Light deal too. That's not bad.
I
like
always
a
love
value
a
play.
Corona, and I love a High Noon, and I love a good vodka soda. So.
Exactly, everything. All right, guys, we got to leave it there. We got to send it back over to Jared Blickery in the studio.
All right, we got some breaking news here. The Federal Reserve out with its annual bank stress test, and in order to determine just how well large banks are positioned to weather a severe recession, here with the results is Yahoo Finance's Jennifer Schonberger. Jennifer, just reading some of the headlines, banks have passed the stress test here, clearing that first hurdle for payments.
Hey there, Jared. That's right. Results from the Federal Reserve stress tests show that 23 of the nation's largest banks could continue lending to households and businesses during a severe recession with plenty of capital on hand to absorb losses from loans. These tests, the first results since Silicon Valley Bank and other regional banks failed earlier this spring, just underscore the fortitude and resilience of the nation's largest banks since they were required to hold capital about a decade and a half ago. Recall the Fed's stress tests were mandated annually by law after the financial crisis for banks with more than $100 billion in total assets. They examine how banks would perform during a hypothetical recession to prevent bank failures in a crisis. This year, the hypothetical scenario, tougher than last year, envisions a severe global recession with acute stress in commercial real estate. Under the Fed scenario, unemployment spikes to 10%, both home prices and commercial real estate prices plunge about 40%, and the stock market plummets 45%. Under that scenario, all 23 banks in aggregate would lose $541 billion. Yet after covering losses, banks would still have capital left over equal to over 10% of total assets weighted by risk. That's well above the 4.5% the Fed requires. Now, the hardest hit area under the hypothetical scenario would be credit cards, with losses amounting to $120 billion, or about 22% of total loans lost. Commercial real estate, along with residential mortgages, coming in a close second, with losses totaling over $100 billion. Those losses on commercial real estate were roughly triple the levels seen during the 2008 financial crisis. Now, taking a look at how the nation's largest banks shake out here, you can see they are all well above the Fed's minimum capital requirements. The same goes for some of the mid-sized regional banks that were part of this test, including PNC, Truist, and M&T. Now, this year, the banks with assets of between $100 and $250 billion were not subject to the test. That went into effect a couple years back, a new law that stipulated that banks with assets of those size would undergo tests every other year. However, the Fed disclosed that a small handful of banks, BMO Financial, Citizens, M&T, and RBC, were actually subject to the test this year. They would have been subject next year. And the reason for that was they mandated a new capital requirement for those banks. Now, RBC elected to opt in this year themselves. They would have been subject next year. Banks are now going to take a look at these results and use them to determine what their capital plans will be. That is, will they change or increase their dividend and stock buyback plans? The results of those from the banks expected to come down Friday after the market close. Jared?
Thank you. And just looking at our Wi-Fi interactive heat map, it's impressive to see some of the gains on this. JP Morgan in the upper left up 0.75%, Bank America and Wells Fargo up about 1% and 0.5% respectively. Thank you for that, Jen Schonberger. All right, coming up, Micron shares moving after the bell and its latest earnings report. We're taking a deeper dive into the numbers on the other side. Stick around. shares of Micron trading higher after reporting better than expected third quarter earnings. And let's get right into the results with Daniel Morgan, Synovus Trust Senior Portfolio Manager. Thanks for your time here today. Just your first impression off this report.
Well, Jared, obviously it was a good report in regards to revenues and earnings. Both of those came in better than expected. I think what everybody's kind of applauding, at least initially on the Micron report, is their projections for the upcoming third quarter. In terms of revenues, they were projecting $3.9 billion plus or minus 200 million. Also, some of the comments that came out in the press release from management basically saying that they felt that we had hit a trough and that revenues were going to hopefully start to improve along with margins going forward. So I think what everyone's kind of happy about, Jared, is that we're looking for a light at the end of the tunnel in regards to memory, because that sector has been hit particularly hard. And I think that this report gave us some evidence that things are starting to turn here in the second quarter and should start to improve going into the back half of this year.
Yes, and I actually have that quote from the CEO. We believe that the memory industry has passed its trough in revenue, and we expect margins to improve as industry supply-demand balance is gradually restored. Could you just talk about, in more perhaps general terms, the cyclicality of the chip industry? And also, we talk about chips and semiconductors, but they specialize, and Micron in particular is levered to the memory side of the equation. Could you just talk about how Micron fits within the industry?
Well, you're right, Jared. I mean, if we look at last year, overall revenues in the semiconductor industry were basically flat. This year, this is a projection from the Semiconductor Association, Industry Association. They're projecting revenues to be down about 11%. If we look at different sectors within the chip space, about a third of the market are chips that are made for PC, tablets, smartphones. The rest of it's kind of split up between servers and auto and some of these other segments. Now, everybody's gotten very excited about artificial intelligence after that Nvidia report that came out last month. And now everyone keeps looking for more evidence that artificial intelligence is stimulating revenue growth in the chip space. But we have to bear in mind, Jared, that memory is a very commodity-based segment. Memory chips go into PC laptops, and then NAND chips will go into the smartphones. So it's not the same as, let's say, Nvidia with their Hopper 100 or their Grace Hopper 200 artificial intelligence chips, which are highly specialized that can command very high prices on. The DRAM and NAND chips or memory chips that Micron produces are very commoditized.
Well, thank you for that. Also want to talk about the headwind from China. We've been talking about the latest push by the administration, what they're floating. And here's a quote. Here's another quote from the earnings report from Micron. The recent Cyberspace Administration of China, the CAC decision, is a significant headwind that is impacting our outlook and slowing our recovery. How much of this is a Micron story versus how it's affecting the entire industry?
Well, Jared, it is a big story for the entire industry, as we heard that this morning with the Nvidia news, but just kind of putting the spotlight back on Micron. If we think about 11 to 12% of their total revenues come from China, about 50% of those revenues will be affected by this potential ban. So it is something that could potentially become a problem going forward. It just depends on whether they can make up sales with the China ban in other markets. Now, Micron in the DRAM and NAND space or memory space, it may be more challenging. Where with Nvidia, because there is such a tremendous demand for their AI chips, they may be able to get over the hurdle of having, for example, the A100 or the 8800 chip potentially requiring licensing. That's what they were talking about today out of the Biden administration. They may make it up for sales in other parts of the world. So it's going to impact different companies differently. But there's no doubt that this is a bad precedent, right? We're getting into this back and forth restrictions between U.S. and China. It's not good for any of the U.S. Chip manufacturers, right?
Yeah, exactly. And just getting back to their fourth quarter projections, I'm seeing adjusted gross margin. They expect it to be -8% to -13%. Estimate was for -2.79%, so expecting much more negative result in adjusted gross margin. Is this a concern for Micron?
You know, Jared, one of the big issues, even on this quarter, we were looking for about a $500 million write-off on inventory, and they took about a $400 million write-off. Now we go into the upcoming quarter and we start to focus on margins. What that basically means is they're not getting as much for the memory chips that they're selling it in terms of their bottom line profit. So I think this is something to kind of take a look at. We know that top line revenue number was above expectations for the upcoming quarter, but obviously this will hopefully get a better explanation in regards to margins, why they seem to be below the street on the upcoming third quarter. And as you mentioned earlier, Jared, in the beginning of our conversation, in the press release, they talked about margins should begin to improve. So need a little bit more color on why we're not seeing that versus expectations on this upcoming quarter.
We got under a minute. Anything we didn't touch on here that you'd like to share?
Well, again, each chip company is different. Micron is going to be a different play than an Nvidia or some of these other companies that are going to more broadly be affected by AI. In the long term, we expect memory increases associated with AI, but it's harder to see it in the next quarter or two where we might get a bigger impact from some of the other companies that we've been talking about.
All right. Thank you for keeping that short, and we always appreciate your time. Daniel Morgan.
Thank you, Jared.
Coming up, we check in on a few tickers that are trending after hours and get you caught up on today's top stories. Stay tuned for that next.
It's almost July 4th, and you know what that means? Fireworks. 60% of consumers planning to watch fireworks this year as part of their 4th of July celebrations. That's up from 46% last year. This is all according to the latest data out from Numerator. So here to discuss what to expect this July 4th holiday and what that means for the firework industry, we want to bring in Phil Grucci. He's CEO and Creative Director of Fireworks by Grucci. Phil, it's great to see you here. So when we compare where we are today to where we were a year ago, lots of talk just about the shortage of fireworks. People weren't going to be able to get their hands on them. And then if they did, it was going to cost a heck of a lot more. What are you seeing this year?
Well, we're seeing the supply chain is loosened a lot. So that question of whether there's stock available on the consumer side. So our sector is in the entertainment business side, the public display side. But on the consumer side, which is where all that fear was coming from, is whether you're going to get your fireworks. That is loosened as well. Our supply side from both Europe and from Asia has loosened. Shipping has gotten a little bit better than it was last year and the year before that. So we have plenty of fireworks this year, I can assure you that.
Good to know and hear. Just based on what's happened over the last few years, we've emerged on the other side of the pandemic, things normalizing. Are we seeing the fireworks budgets going back up, and where are some of the biggest displays?
We are seeing the budgets coming back to 2019 levels, and the volume of firework displays that we had back in 2019, actually we're up about 30% on that. But where the larger displays are, we have we produce about 67 shows between here in New York, all the way out to Hawaii, to Pearl Harbor, Hawaii, and down to SeaWorld, Florida. So we're producing their nightly displays down there, and the larger programs are out on Long Island. We're having one actually kick off the weekend at TD Bank out in Eisenhower Park. Las Vegas is a huge market for us, and down south and all around New York, and 67 of the locations around the country. 400 pyrotechnicians will be deployed within the next 4 days.
Wow. That's a lot of people. I mean, it makes sense when you take into account all the demand out there. Phil, my question to you is, you mentioned the fact that the demand that we're seeing right now, your business, back to the levels, or right near the levels, I believe what you said, in 2019. Does that mean that the firework industry is somewhat recession-proof, given the fact that companies are pulling back their spending elsewhere? Towns have decided to reallocate their budgets, but it seems like demand for fireworks is just as strong.
Where we see the undulations is pre and post the 4th of July, Independence Day. Thank goodness for John Adams when our Declaration of Independence was penned, and him writing to his wife stating, "We shall celebrate with bonfires and illuminations from coast to coast." He practically wrote that into our Constitution, that there should be fireworks on the 4th of July. So our 4th of July is certainly recession-proof, and on the consumer side, it's the same thing. If people want to celebrate, they want to celebrate our independence. But the pre and post, or in the off season, as we call it, which is flattened out to a good way in an upward trend, we're busy throughout the entire year. In fact, we have two peaks. One is New Year's Eve, because New Year's Eve, everyone in the world celebrates New Year's Eve. So we're very busy. We're very active in the Middle East, Saudi Arabia, Dubai, Abu Dhabi, and then also here in the United States. So we see both of those bell curves. Kind of a joke in our studio is, when is that off season coming?
You mentioned John Adams. I looked this up because I thought I remembered this from my elementary school education, but he died on July 4th. He was sick at the time, managed to prolong his death until the independence of this nation. That anniversary. Also, Thomas Jefferson. All right, I'm just adding that little tidbit there. But I do have a serious question, a kind of serious one. We've seen AI, artificial intelligence, take the world by storm. Is it getting entrenched into the fireworks business, or is that just some pie in the sky?
It's not so much entrenched into our fireworks business, but we have another sector of our business within the Grucci companies. We manufacture quite a lot of material because of the synergies for the Department of Defense in the training side, simulation of explosives, where sparks, smoke, bang, we're seeing it there. It's actually, for us as a small business, in respect to the larger companies, the Raytheons and the General Dynamics, the AI is really coming down hard on our requirements for compliance. So we're seeing that in a big way as far as affecting our cost structure.
Interesting. And just in terms of your cost structure, what about labor? Anything else contributing to increases there?
Yes, to where our CapEx is up about 60% now because we're investing in automation. It's very difficult to to get those individuals that want to work in a factory environment down here. Our pyrotechnicians that go out in the field to display, we don't really have many problems with that because it's more of a part-time task, part-time job. But we have 160 to 170 employees in our factory down here in Virginia, and that's the difficulty that we're having is those individuals that want to come to a factory environment and work. So it's requiring us to shift our resources towards automation.
Automation spares no one, and I look forward to perhaps seeing some of your fireworks from a distance this weekend. Thank you, Phil Grucci, CEO and Creative Director of Fireworks by Grucci. All right, let's get it over to...
Have a happy Independence Day, Jared.
You too. And let's get it over to Shauna Smith for some after-hours movers.
All right, Jared, let's take a look at some of these movers here. We have a couple of names for you. Starting it off with Micron, we're looking at a gain of just about 3.5% in extended trading. A move here to the upside following their better than expected results after the bell here this afternoon, beating for the third quarter. The guidance was also strong. The company saying, the CEO saying that the memory chip industry has passed its bottom in revenue. Obviously a good sign here from Micron and also the industry at large. The upbeat forecast is certainly a sign that the glut is easing, something that Micron and many of its peers has been struggling with in recent months. And the better than expected results and guidance coming despite some of those headwinds, challenges that the company is facing over in China. And we know China cracked down on Micron's chips. Micron is saying that it is a challenge here for the company moving forward, but they still see strong demand here in the U.S. and elsewhere. Shares up just about 13% over the last 3 months. Let's flip it over to the three banks that we're tracking here. Bank of America, JP Morgan, and Goldman Sachs all moving to the upside in after-hours trading. These banks, plus all of its peers, all 23 of the largest U.S. lenders, passing the Fed's stress test. Now they can withstand, proving that they can withstand any sort of severe recession. This, of course, leading the way to future payout announcements. Those, though, might be a while. Several of these banks have indicated that they are waiting for more clarity on the new capital structures before they announce that. You're looking at Bank of America, that's like up almost 2%. Rounding it out with Overstock, that stock also to the upside here in extended trading. A couple of headlines coming out from the company Overstock saying that it plans to launch Bed Bath & Beyond online in Canada, followed by U.S. weeks later. The U.S. launch is going to include a refreshed website, mobile app, and also the loyalty program here. Now remember, Overstock was the winning bidder here for Bed Bath & Beyond's assets. They paid $21.5 million for that. And taking a look at the 7-day move here in the stock, you can see the big spike that we saw just around Thursday of last week once that was announced. Over the last 7 days, looking at gains of about 16%.
Yeah, Overstock. So many people have counted that stock out for so many different reasons over the years. Taxed by short sellers, still cooking there. Well, it's closing time here at Yahoo Finance, and here's a look at some of the top stories of the day. Chip stocks under pressure today on a report the U.S. may be considering export restrictions on AI chips to China. The Wall Street Journal first reporting the announcement could come next month, as concerns rise about American technology being in the hands of rivals. This action would follow rules the Biden administration implemented back in October to attempt to freeze China's semiconductor industry.
Meantime, President Biden making his economic pitch to Americans. Biden speaking in Chicago earlier today, trying to turn Americans' views around as he ramps up his re-election campaign. He touted the recovery from the pandemic, but also said there is work that remains to be done. He's not declaring victory on the economy.
Finally, Fed Chair Jerome Powell reiterating his hawkish stance on raising rates. At a European Central Bank conference, he said 2 consecutive rate hikes are on the table. He said, quote, although policy is restrictive, it may not be restrictive enough, and it has to be restrictive for long enough. He also warned that inflation will not come down to the Fed's 2% goal this year or next year.
All right, well, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a good night.